Hello, the Principal Finance students. This video clip will be reviewing how to calculate the maturity under the bond issuance with the semi-annual case and the quarterly the payment case. First, the question is how long years is the maturity of a bond with 6% coupon rate of a semi-annual payment and $1,000 face value that is currently trading at $900 for 8% YTM. Okay, so YTM represent the market rate. So when you put the rate input, it should be always market rate. You do not put the 6% coupon rate there. The coupon rate is only for calculating the payment, coupon payment, every the semi-annual basis. So the market rate is 8%. But you should remember that the semi-annual payment, so the market rate of the half of a year is now the 8% divided by 2. So the 4% is market rate is semi-annual. Then MPR is what we want to calculate. The payments, now we use this 60%, $1,000 per value minus $1,000 times 6%. This is the annual coupon amount, but the coupon payment recurs every semi-annual, so we have to divide by 2. Why do you put the negative sign there? Because the company, when the company issue their bond, the cash amount every semi-annual basis, they have to distribute the cash out. So the $30 for semi-annual coupon payment shows as negative amount. Then it is traded at 900. Why it is positive? Because the company sell this bond, then 900 is on their hand. And then the future value, which is face value at the end of maturity, company should pay back. So this is minus. Now let's put the MPR function with 4, comma, and 900, and then 1,000. So 13 years, no, it's not the 13 years. That is the 13 number of period. We have calculate intermediate process to come up with years. Now, the number of period is 13 times. 13 times, then we can get the years. Now, years divided by 2. So that we can come up with 6.5 is the maturity. Next case, how long is the maturity of a bond with 8% annual coupon rate for quarterly payment and $1,000 face value, and currently traded at 1,200 with 6% YTM. Now, the payment recurs every quarterly basis for the year. So the rate now we want to use for the discount rate or a YTM or the market rate is 6% now divided by 4. So 1.5 is the quarter rate. And the MPR is what we want to get. Then PMT, again, $1,000, the par value times 8% annual coupon rate divided by 4, because the coupon payment recurs 4 times for a year. So actual payment of a coupon for the quarterly basis is $20, and the present value is 1,200. And then the future value, the face value or the par value is negative $1,000 because the company should pay back with this amount, par value at maturity. MPR is MPR. Now 1.5 quarterly rate, payment, present value, and par value. Then we get 61 times of number of period. Then how do we convert this 61 times of the number of period? That's correct. We should divide it by this number 4. So 15.39 is the years. Okay? Then let's talk about the yield to maturity. Yield to maturity is for the perspective of investors. For the perspective of investors, now we measure the YTM, which is we assume that the investors will hold this bond until the maturity. So a bond currently sells for 850. It has an 8-year maturity, and annual coupon rate 8%, and the par value 1,000. What is its yield to maturity? Is current yield and its capital yield. As we learned during the class, the YTM is the current yield plus the capital yield. The current yield can be calculated annual coupon payment divided by market price. So the capital yield also we can transform this formula. Just take this, the current yield, the other side, then YTM minus current yield is capital yield. Okay, then let's put this inputs on the table. The rate is what I want to get, and the MPR is 8 years, and the PMT, how to get it? $1,000. Now we put the positive number because you have to put yourself into the investor's perspective. Why? We are dealing with yield. Yield means return. So 1,000 times 8% is the coupon amount for the year. And then we pay, as an investor, we pay how much? 850. That's why the present value is negative. But at the end of the year, we'll receive $1,000. At the end of the maturity, we'll receive, as an investor, $1,000. Then the rate is now can calculate its input. So the yield to maturity is 10.9%. 10.9%. And then current yield. How do you get the current yield? Current yield is the coupon amount, which is determined, fixed, divided by the purchase price. That never changes. So here, $80,000. $80,000 divided by how much is the price? Okay, 850. So the 9.41% is current yield. Then the capital yield is just difference between two. Why capital yield is positive? Because when the investors invest $850 of this bond, but the investor will receive $1,000 at maturity. The difference, this 150 for 8 years, is the capital yield in annual. You guys understood? Then this case is now we put that information in the same way. Then yield to maturity is 6.37%, and the current yield, how to get it? Again, the coupon payment divided by market price is market price. How much is the market price? Okay, 1,100. So 1,100, we put it. So 7.27. 7.27 is current yield. Then the yield to maturity minus current yield is now minus 0.91. Why it is showing the capital yield? Why is the capital yield showing the negative? Because the investors purchased this bond at 1,100, but they receive $1,000 at maturity, so the capital yield is negative. But the current yield is greater than yield to maturity. Why? Because the investors receive 8%, which is greater than 6.37% yield to maturity. Anyway, the compensation for the current yield, income yield, is 7.27%, but they lose the capital yield, 0.91%. So anyway, the yield to maturity is required rate of return of this bond. Okay, see you the next video clip.